Big tech Q4 earnings season started today, with Microsoft being one of the first companies to report. And given that Microsoft was one of the first big tech companies to report, there's a lot of takeaways we could get from their earnings. Without any more talking, let's get right into some of the results and some of the things that came of their earnings release. So to summarize the results, the market was expecting a revenue of about $52.9 billion. And we got revenues of about $52.75 billion. So when it comes to EPS, we're expecting $2.30, and we ended up getting $2.20. And for net revenue, we're expecting about $17.1 billion, and we ended up getting $16.4, which are all slight misses to the downside. So some of the highlights from the earnings release is that cloud revenue was up this past quarter by 32%, mostly driven by the Azure commitments. Azure revenue itself was up 46%, which beat the 41% growth rate that we had in the previous quarter. And this has been a pretty big worry of the market, as it's expected that Azure's growth will be slowed down by macro conditions, but we'll get more into that later on. So going through the report, we saw that product revenue is down about 20% from the same quarter in 2021. And service revenue has actually taken the opposite route, and it's up 17% from the same quarter in 2021. And this makes sense given that we have seen a significant softness in PC demand. And most investors are interested more into the services side of this business, as it seems to be more growth oriented. So it is a good sign that we are seeing services continue to grow. When it comes to the product segment, cost of goods sold as a percentage of revenue, it came in at about 34% compared to 30% in the same quarter in 2021. And this shows that margin on products are starting to become worse, which again, we expect because we are seeing a slowdown in demand. But when it comes to services cost of goods sold as a percentage of revenue, that has actually gone down to 32% compared to 34% we had in the same quarter in 2021, which shows that margins are getting better. Now, when it comes to OpEx side of things, all categories as a percent of revenue have increased, but it's only been about 1 or 2 points. So it's not too bad, but it is still a little bit worrisome to see. So now moving on to earnings call, we did get Q3 guidance in the earnings call. And overall, the guide was a miss from the expectations of Wall Street. For a company's guidance, slower growth in Q3. And they expect Azure's revenue to take about a 4 to 5% hit compared to the Q2 growth rate, which is significantly more than what the market was expecting. So the market was expecting a hit on this segment, but they weren't expecting a hit that large. And the company also guided for no gross margin improvements, mostly because of the build out of their cloud infrastructure. And this was a little interesting because Microsoft did just lay off 10,000 employees. So you would think that their gross margin would get better with that, but apparently they're not expecting that to happen. So during the Q&A portion of the earnings call, the company was asked if they predict that they will need to do more layoffs in the future. And the CEO responded to this by saying that they believe that their exit rates are sufficient enough for them to avoid having to make more layoffs. For those of us who have been following the inflation news and everything, we do know the Federal Reserve's goal is to kind of slow down the job market. And typically when the job market slows down, people aren't as eager to look for a new job. So there is a chance that the exit rate might slow down at this company. And if it does, they may have to lay off even more employees to get to where they want to be in terms of margin. So that's something good to keep in mind. Later on in the conference call, the line abruptly dropped in the middle of the CEO responding to a question about the possibilities of AI for Microsoft in the future. I'm not sure if the CEO said a little too much and like a suit came with scissors and like cut his cord or something like that. But anyways, that was pretty much the end of the call. So it was stopped a little bit abruptly. Overall, the results was along Wall Street expectations. And it did end up moving up in after hours once we did get the report quite significantly. But a lot of that upside was taken away once guide was given during the earnings call. I think this was mostly given to the fact that the market was extremely bearish about Q4 earnings. So to get something along expectations was a little bit of a shock. The guidance of slower growth wasn't really good news for investors. But again, I think that this was what the market was expecting. So personally for me, I can't give you personal financial advice. But for me personally, this isn't a company that I'm jumping up and down to invest in just yet. For me, I actually had a position in Microsoft and I had to sell it to cover some outlays that came up. I do think this company does have some pricing power when it comes to the service side of their business. But I think a lot of that pricing power is getting significantly compressed just given the slow macroeconomic environment. And given that they are selling mostly B2B products, I don't think that this is really the best time to jump into Microsoft just yet.
So that's basically all I got for you guys. Thank you so much for watching. As always, please like and subscribe if you haven't already. Also, share this video with a friend if you think they could get value from it. And I'd like to thank you so much for watching. I'll see you in the next one. Peace.